Hey everyone, this video is sort of on an introduction to transactions. Your goals for this video are to be able to define a transaction and explain its connection to the fundamental accounting equation, which is assets equals liabilities plus owner's equity. Since you just learned this, you might still be thinking of it more like owner's equity equals assets minus liabilities, which I used to do too, but that's just because you're just starting to learn what equity is, right? And that's a good way to understand it. But here we rearrange that equation as assets equals liabilities plus owner's equity, just like we did on the balance sheet. And that's going to be really important to every transaction that you think about. And number two, in this video, you're going to correctly change the value of accounts. You're going to tell me which accounts need to change and by how much, just based on a simple transaction, like a single sentence that you're told about something that happened to a business. For example, if we are a hair salon and a customer gives us $30 for a haircut, you're going to be able to tell me which accounts, at least two of them, change and by how much when a customer gives us $30 for a haircut. Spoiler alert, if they give us $30 cash, then we would just say the two accounts change would be cash would go up by $30. And for now, we're just going to say the owner's equity in the business also goes up by $30. Our share of the business is now worth $30 more because that $30 we were given was not financed through debt. Therefore, it's financed through equity. So anyway, more on that coming soon, and I hope that will make really good sense. And I'll show you a bunch of transactions at the end of this video, and hopefully after you see that, that'll make sense. So this video, I'll tell you what a transaction is. You'll get some practice recording them, or at least seeing me do it, and I'll start by telling you a little bit more about this equation. I don't really need to, though. Just the way as a way to review that assets equals liabilities plus owner's equity. Just think again about this balance sheet, okay? So the assets is on the left of the balance sheet. And as we learned last class, or let's say over the last several classes, we always end a balance sheet on the right side by showing the total liabilities and equity and how that equals assets. So this equation is really core to what we've been doing. And one of the main reasons that we put it in this order, assets equals liabilities plus equity, one of the main reasons is because that allows us to do transactions correctly. So, what are transactions? A transaction is so simple. It's just any economic event, something of economic significance, even if it's really really small, happened that changed the financial position of a business. That example I told you of a customer giving us $30 for a haircut, that's a transaction. It's going to economically change our financial position, even if only in a small way. Okay? The financial position of a business, as a reminder, is simply reflected in the nature and size of its assets, liabilities, and owner's equity. This is why the balance sheet is all about the financial position of a business. So if anything happens to change our assets or our liabilities or our equity, could be multiple of these, it could just be a couple accounts within one of these categories. If anything happens that changes any of this, what we own, what we owe, what our company's worth, we call it a transaction. And you're going to see that it's super broad, right? So, what are some examples of transactions? Well, it could be an owner just withdrawing money out of the business or an owner putting money into the business. It could be us selling something like a haircut. It could be us paying our employees, buying supplies, buying a new piece of equipment, paying for utilities, like paying our electricity bill. All of these things are transactions because they change the financial position of the business. So, for this video, what I will aim to do here is get you to a spot where if I tell you something like that, like we paid our electricity bill for the month, you can just simply tell me, oh, okay, here are the accounts that are gonna be affected by this many dollars. And then you'll just make sure you're correct by making sure the left side and the right side of this equation balance. So the next step is making what I just said make sense, hopefully. So here's how I'm going to try to do it. Here are the rules for transactions. First of all, make sure it is a transaction. The financial position of a business has to change. If I tell you that the owner of a business themselves went and got a haircut, chances are that's not a business transaction. It's personal. Okay. Second thing, for every transaction, at least two accounts must be impacted. An account, by the way, can be something like cash or account receivable, the value of our equipment, how much we owe in accounts payable, how much we own in a bank loan, the owner's equity, Ryan Vashon, comma, capital. So all those could be accounts. Anything you see on that balance sheet could be considered, let's say, an account for now. Okay. And again, like I said, for every transaction, you're just going to make sure this equation balances. So if this is feeling confusing, it won't for long. I'll give you a bunch of examples starting in the next slide. And hopefully these very simple rules will make total sense. It's very logical. All transactions must be based on objective proof of transaction. So that's just an important note that has to be said here. So there's something called the objectivity principle before you do transactions. It's just a note that all accounting transactions, of these little financial events that a business has to record, they have to be based on something clear, that's a piece of evidence. So there has to be verifiable evidence that can be looked back at to demonstrate that this transaction actually happened and that the dollar amount that we say it happened for was correct. Okay, we can't just put down whatever we want to for our monthly electricity bill. Okay, it has to be based on something called a source document. There has to be something we can trace it back to, like a bill or a receipt or a check copy, credit card slip, cash register summary, purchase invoice, sales invoice. These are source documents, and these are the things that serve as the verifiable and clear evidence of transactions. Okay, which the objectivity principle, a generally accepted accounting principle, says that all companies, all businesses need to do from an accounting perspective. We need to have proof of each transaction. Okay, so transactions. Let's look at some examples. You'll see how easy they are. So the one thing I'll do after I do each one of these is I'll just go back to this equation at the top. Okay, and I'm going to make sure that the left side of the equation and the right side of the equation are in balance. So here's a transaction. A business buys a new sofa for the office for $900, and we paid cash for it. So what are at least two accounts? These accounts can either be assets, liabilities, or owner's equity that are going to be changed by what happened here. Well, what's the first one that's pretty clear? We just paid $900 cash for something. So the business's cash will decrease by $900. But is that it? Well, no, because if all that happens is cash, which is an asset, decreases by $900, then this equation will no longer be in balance. What else happened here? What do you think is the other account that needs to change for the business? Well, the answer is we have a new sofa now. Okay, so the value of our furniture, which we'll say is an asset, the value of all of our business's furniture has gone up by $900 because we just bought a $900 sofa. So we would also say that a second account is affected. That says 900. That says plus 900, or it's meant to. $900. So that's the end of the transaction. Okay, two accounts were affected. Furniture went up by 900, cash went down by 900, and the equation still balances. The right side didn't change, it's at zero, and the left side, assets, it's a net zero. One of our assets went up by 900, furniture, one went down by 900, cash. So I hope that makes good sense. Okay, let's do another one. So the rest are kind of similar on this slide. So we bought a new sofa for $900 this time. We didn't pay cash. Instead of paying cash like in the first one, here we're going to pay them back next month. So here, what changes? Which accounts are affected by this transaction? Well, again, our furniture goes up by 900. So we'd say our assets go up by 900. But this time, instead of our cash going down by 900, we owe ABC Furniture Company $900. So we would say we have an account payable to ABC Furniture for $900. Okay, so this is a new account payable. So our liabilities, our debts have gone up by $900. We're going to add an account payable now to our balance sheet for $900. And that's the end of the transaction. Do the two sides balance? Yes, they do. The left side went up by 900 and the right side went up by 900. All right, and just to wrap this example up, what if it were a little bit different? What if we still bought this sofa for $900? So we're still going to have plus furniture, one of our assets, by 900. But this time we paid $600 upon purchase, and we're going to pay the remaining $300 next month. Okay, so this time we bought the sofa. We gave the company $600 cash today, and we're going to pay them the remaining $300 next month for whatever reason. Well, what else changes? Here we're going to have more than two accounts affected. Here, in what happened, our cash went down by 600. So here we'd say cash goes down by 600, and accounts payable go up by 300 because we now owe $300 to them, so we have a new account payable. So let's list it out again. Assets equals, oops. Taking my time here. Sorry about that. Really taking my time here. Assets equals liabilities plus owner's equity. Let's list them out. Well, we had one asset go up by 900, furniture. We had one asset go down by 600, cash. And then we had a liability go up by 300. Do things balance? Yes, they do. Our assets overall went up by $300, and our liabilities also went up by $300. So the left side and the right side have both gone up by $300. Hope that makes sense. A couple more examples really quickly on the next slide, just to show you some that affect owner's equity, and then that'll be the end of this video. So this slide here, number 4, we have a business making a service sale for $29, just like the haircut example I said earlier. What are the two accounts affected here? You can pause it if you want to and try and guess. Okay, so here we have cash in our business going up by $29, and the owner's equity of the business will go up by $29. Okay, you think of it here like the value of our business has gone up by $29 because this is $29 that just got effectively put into our business that wasn't there before by a customer. We're keeping it simple with a service business. Later in the course, you might not get to keep the whole $29, but yeah, we'll talk about that later. Number 5, the business pays $400 for monthly electricity. So in the number 5 transaction, what happens? Well, our cash goes down by 400 here. And monthly electricity, well, here we'd say our owner's equity will go down by $400. Later, we'll call this an expense. More specifically, we'll call our expense account $400. And same thing for number 4. Rather than this service call simply adding 29 to owner's equity, later in the course when we learn more, we'll simply say revenue of $29. And finally, number 6, owner withdraws $1,000, not for the business, but from the business I meant to put. So we'd say our cash in our business goes down by $1,000, and we would say the value of our business to the owners would also go down by $1,000 in the case of an owner withdrawal. Okay, so at this point, not sure where you're going to be. Hopefully the basic idea of transactions makes some sense, and I'll probably put a couple on the next slide just for you to try out. Okay. If anything is confusing at this point, maybe it's this idea of owner's equity. That last slide, 4, 5, and 6. How? Wait a minute. Why does the owner's equity go up or down? But hopefully you see how all those last 3 examples I just did, number 4, number 5, and number 6, how each of them will either increase or decrease the value of a service business. Customer gives us money, that's going to increase the value of our business, so we'd say owner's equity goes up. Expenses we have to pay out. We're not really getting any assets or anything for that $400. We just simply have to give away $400 for the expense of electricity, which we do need to do. But we'd say in that particular daily transaction, in giving that $400 away, we didn't acquire any assets. Simply put, in that transaction, the value of our business went down by $400. Same thing with the owner withdrawing money. So hopefully that makes sense for now. And yeah, I'll end the video at this point. So again, what you learned, hopefully, and what we're learning is to define a transaction. Can you explain to me what a transaction is? Can you connect how transactions relate to this formula? And finally, if I give you transactions, are you able to tell me which accounts are changed and to make both sides of the equation balance? We're going to take lots of time practicing this in class. Okay, thank you all.